Some taxpayers may tell you that tax loss harvesting saves you about $3,000 a year in taxes. Sounds nice, right? But it is often completely wrong, or at least it is missing the much bigger picture. If you are a retired couple with $1.8 million and a taxable investment account and you harvest your losses the right way, you may not be saving $3,000. You could generate over $150,000 in permanent tax-free wealth during your retirement, depending upon your situation. Not $3,000, over $150,000. The math depends on, of course, your specific situation, but once you see how it works, you will understand why this is one of the most powerful tax strategies we believe for your investment portfolio long term. Today, I'm going to walk you through the exact math step by step. Plus, I'm going to reveal a rule I call the tax eraser, a mechanism that makes this $150,000 permanent under current law. Almost nobody, at least that I could find, explains it on YouTube. So let's go ahead and dig in. If we haven't met yet, I'm Mark Vonville, CEO of Covenant Wealth Advisors right here in Richmond, Virginia. And after working with affluent retirees for the past 20 years across the United States, I see a similar mistake over and over again. Couples with large taxable accounts never do the math on how tax savings actually snowball over a 25 or 30-year retirement. And the problem? Well, they hear about the basic $3,000 tax deduction when taking a loss on their investment account, and then they just stop there cold. Today, we're putting the whole puzzle together for you. I'm going to show you 3 completely different tax benefits that actually stack on top of each other. You will see the actual dollar impact of each one. And the third one, the tax eraser, is the one that catches many folks completely off guard, so be sure to stay until the end. So let's start right here. Most people think tax loss harvesting works just like this. You sell a losing stock or mutual fund, for example. You deduct $3,000 of that loss against your income. At a 22% federal tax rate, that saves you about $660 a year. Over a 25-year retirement, that adds up to $16,500. It's a nice number, and that is the story you often hear, except that is not where the real money is. When you actually harvest losses systematically over a long retirement, 3 separate benefits combine to build wealth. One, your losses can offset your capital gains, not just $3,000 a year, but potentially much larger amounts. Secondly, you still get $3,000 income deduction every year. That part is certainly real. But 3, and this is the game changer, tax loss harvesting acts like an interest-free loan from the IRS. And if you handle your estate correctly, that loan gets completely forgiven and the wealth you built with it becomes permanent. Now, I know that sounds technical, but I'm going to show you why it is worth more money than the first 2 benefits combined. If you are new to the channel, be sure to subscribe so you'll be notified when we release more tax saving strategies and retirement income strategies in the future. So let me show you the actual math about what I'm talking about here. Meet Jim and Linda. They are 62 and recently retired. Jim was a sales director. Linda ran HR for a regional hospital. They have $3 million total, but $1.8 million of that is in a regular taxable brokerage account. For 2026, they are in the 22% federal ordinary income bracket, and their long-term capital gains rate is 15%. Now, here's what we assume for illustrative purposes only. Jim and Linda harvest an average of $20,000 in losses every single year for 25 years. That takes discipline, but it is possible if you have a properly diversified portfolio with normal market ups and downs. Some years it is more, some years it is less. In this hypothetical example, over 25 years, that is $500,000 in harvested losses from the portfolio. So here's how mechanism 1 and 2 work together. Out of that $20,000 annual loss, they use $17,000 to offset capital gains they realized from rebalancing their portfolio or selling stock to fund retirement spending. Capital losses offset capital gains dollar for dollar. There's no cap no limit. At their 15% rate, that saves them $2,550 a year in taxes. But what about the remaining $3,000 in losses? Well, that triggers what we call mechanism 2. They deduct that $3,000 against their ordinary income. At their 22% rate, that saves them another $660 a year. Add those together, $2,550 plus $660 equals $3,210 in taxes saved every single year. Over 25 years, Jim and Linda have saved $80,250 in taxes, and they did not have to send it to the IRS. And that is real money, but it is just the foundation. By the way, what is your biggest tax headache with your portfolio right now? Drop it below in the notes. I'd love to see, because I may just use your comment as fuel for my next video. Now, you might be thinking, Mark, $80,000 is great, but the title of this video said $150,000. Where is the rest? Well, this is where compounding comes into play, and this is the part that most tax loss harvesting videos completely skip. Jim and Linda did not take that $3,210 in tax savings every year and stuff it in a mattress. They left it invested in their portfolio. Now, when you leave that $3,210 invested every year, it grows. If we assume a reasonable but hypothetical 5% annual return over those 25 years, that $80,000 of saved taxes snowballs into over $153,000 of extra wealth in their portfolio. So let me say that again, because they did not write a check to the IRS every year. That money stayed in their account, earned returns, and turned into $153,000. But here is the catch. The IRS is not stupid. When you harvest a loss, you have to buy a new similar investment to replace the one you sold. And because you bought it at a lower price, your cost basis drops. That means your unrealized gains actually get bigger over time, not smaller. If Jim and Linda sold their whole portfolio while they were still alive, they would owe a massive capital gains tax bill. The IRS would come knocking for all of that deferred tax. So think about it in this way. Tax loss harvesting is basically an interest-free loan from the government. It lets you keep more money invested, and that money grows. But eventually, the IRS expects to be paid back, unless you use mechanism 3. If this way of thinking about taxes is new to you, hit subscribe. We break down retirement, investing, and tax puzzles every single week, the things your other advisors may not explain. Here comes the part that changes the entire picture. Mechanism 3 is called the step up in basis at death. It is in the tax code under IRC Section 1014. Almost nobody connects this rule to tax loss harvesting, but it is the ultimate tax eraser, as I'd mentioned earlier. And here's how it works. When Jim or Linda passes away, the cost basis of every investment in their taxable account legally resets to the current market value on the date of death. So think about what that means for a second. Remember that interest-free loan from the IRS that we talked about? Remember how every year of harvesting was lowering their cost basis and building up a bigger and bigger deferred tax bill? Well, when they pass away, the step up wipes all of it out. The loan is forgiven. The deferred gains vanish. Their beneficiaries, let's say their kids, inherit those assets at the new stepped up value, and they do not owe a single penny of tax on all the gains that built up during Jim and Linda's lifetime. So I'll be honest with you, this is the mechanism that even experienced advisors overlook. They hand you a report showing how much tax they saved you this year, but they do not tell you the full story. Without the step up, tax loss harvesting is really just a tax delay. It is the step up that turns it into permanent wealth. And that's the distinction that matters. Now, I want to be clear about something. Jim and Linda would have received a step up on their portfolio no matter what. Every asset in a taxable account gets this treatment at death. So the step up itself is not unique to tax loss harvesting. But here's what is unique. Without tax loss harvesting, they would not have had that extra $153,000 sitting in their portfolio. The harvesting created the wealth. The step up made it permanent. Those are two different things working together, and the combination is what makes this so powerful. Total wealth created and preserved over $150,000. That is not $3,000 a year. That is the cumulative impact of running your taxable account with intention over a full retirement. So here's the real question. Are you and your spouse on the same page about your estate plan and how the step up works? Drop a comment. What is the biggest planning conversation you two still need to have together? I think this is an important one. Now, before you go out and sell every losing position in your portfolio, let me warn you about what trips people up. The biggest mistake is the wash sale rule. The rule basically says something like this. If you sell a position at a loss, you cannot buy what's called a substantially identical security within 30 days before or after the sale. That is a 61-day window. If you violate it, the IRS disallows your loss entirely. Now, what does substantially identical mean in practice? Well, you cannot sell an S&P 500 index fund and buy the same S&P 500 index fund 2 weeks later, for example. But you can sell it and buy a total stock market fund or a similar large cap fund from a different provider. Those are not substantially identical. But here's the trap that catches affluent retirees, and I call it the IRA wash sale. Let's say you sell an S&P 500 index fund at a loss in your taxable account. Smart move. But you forgot that your traditional IRA or 401k is set to automatically reinvest dividends into a substantially identical S&P 500 fund. If that IRA reinvestment happens within your 61-day window, you just triggered a wash sale across your accounts. And here's the worst part. When the wash sale is with an IRA, that loss is gone permanently. You cannot recover it ever. Second mistake, forgetting to coordinate with your spouse. If you are married and filing jointly, the wash sale rule applies across both of your accounts. You sell a stock for a loss, your spouse buys it, and their account 2 weeks later, you just lost the deduction. And the third mistake is trying to harvest losses in the wrong accounts. You cannot harvest losses in an IRA or a Roth IRA, for example. This strategy only works in a taxable brokerage account or taxable trust account, for example. And if most of your wealth is in IRAs, tax loss harvesting is less impactful for you. But if you're like Jim and Linda with $1.8 million in taxable investments, it's enormous. So one more thing before we get to the action items, and this applies specifically to those of you with higher incomes. Every dollar of capital gains you realize adds to your modified adjusted gross income. And if your MAGI exceeds $218,000 as a married couple in 2026, you hit an IRMAA cliff, and that is Medicare's income-related surcharge. It is not gradual. Go over by $1 and the entire extra premium kicks in. That can cost you an extra $2,000 or more per year. Tax loss harvesting helps here too. When your losses offset your gains, those gains do not show up on your tax return, which means they do not push your MAGI higher, which means they do not trigger IRMAA. For affluent retirees, that is an additional layer of savings on top of everything we just discussed. So what should you actually do with this? If you have $1.5 million or more in taxable investments, here is your checklist. Number one, find out your actual unrealized gains. Pull up your brokerage statement and look at the difference between current value and cost basis. You should look at every purchase you made, what we call tax lots, not just the average. If you are sitting on, say, $10,000 or more in unrealized gains, tax loss harvesting can meaningfully help you manage that number. Two is check your automated settings. Go look at the dividend reinvestment rules across all of your accounts, especially your IRAs. Make sure you are not accidentally set up to trigger the IRA wash sale trap we just talked about. Three, stop harvesting reactively. If you only sell losers in December because the year is almost over, you are leaving money on the table. Systematic harvesting means you have a plan for the entire year. You know what you are going to harvest, when, and what you're going to replace it with. Four, talk to your CPA or your wealth advisor together. The wash sale rule carry forward tracking and optimizing for the step up at death is pretty complex, and it requires coordination between your investment strategy and your tax return. You really just do not want to get this wrong when you implement it. So here's what I want you to do right now. Copy the link to this video and send it to your CPA or your financial advisor. Seriously, just ask them, are we properly implementing tax loss harvesting in my portfolio? If so, how do we know we are doing it correctly if you have accounts outside their management? And are we optimizing for the step up at death? If they are not thinking about this, they should be, and this might help with your situation. Now, in our experience, many financial advisors don't fully integrate the tax planning with your investments, but doing so is so critical. If you want to see how we can help you fully integrate your investment plan with your tax plan, we offer a complimentary retirement strategy session. No pitch, no pressure, just two smart people talking through the numbers to see if it makes sense to work together. Just head over to covenantwealthadvisors.com or just hit the link in the description below. And here's what we have not talked about yet. What happens if one spouse passes away before the other? In most states, the step up at death only applies to half the assets in a joint account. The surviving spouse keeps their original cost basis on the other half. That creates a completely different tax reality, and it is an estate planning puzzle that changes a lot of this. Be sure to subscribe to our channel, by the way, if you want to be notified when we launch a video on that topic. Thanks so much for watching. I will see you on the next video.